62.8 trillion. That's how many AI tokens flowed through a single third-party routing platform in 1 week in July 2026. Just a year earlier, that number was barely 2 trillion. That's a surge of more than 23-fold in about 12 months. And Jensen Huang? He's on record saying he sees at least $1 trillion of AI demand by 2027, and that right now, supply can't even keep up. So here's the question every investor in this space needs answered. How much higher can enterprise token consumption actually go? Today, we're breaking down the data, the 4 big growth drivers, the forecasts, and the very real bottlenecks. Let's get into it. First, a quick level set. What exactly is a token? Think of it as the basic billing unit of AI. Every time a model reads or generates anything, a word, part of a word, a punctuation mark, that's tokens. And every token consumed means GPU compute and electricity burned in a data center somewhere. NVIDIA's Jensen Huang calls this token economics. His view is that inference is now the core AI workload, and the token is the standardized, measurable, tradable input. For companies, the conversation is shifting from how many tokens did we use to what value did those tokens produce. And for investors like us, token volume is a leading indicator. It maps directly to whether the hyperscalers can digest their massive capital spending and to long-term demand for chips and memory upstream. Now look at the actual data, because it is striking. OpenRotor, a third-party token routing platform, saw weekly token consumption climb from about 2.1 trillion at the end of June 2025 to 7.6 trillion in early January 2026 to 62.8 trillion by early July 2026. A gain of more than 23-fold. And zooming out globally, official data out of China shows nationwide daily token calls jumping from roughly 100 billion in early 2024 to over 140 trillion by March 2026. That's more than a 1,400-fold increase in 26 months. Volcano Engine, ByteDance's cloud platform, has been seeing daily consumption roughly double every 3 months. But here's what's really interesting. The tasks themselves are getting heavier. A simple chatbot exchange might burn 1,000 to 3,000 tokens. An AI agent running a deep research task is a completely different animal. It perceives, plans, executes, reflects, loop after loop after loop. A complex task can chew through millions of tokens. And Anthropic's own research found that multi-agent systems can consume up to 15 times the tokens of a single agent. At the same time, the industry has hit an inflection point, from what insiders half-jokingly call token maxing to real budget discipline. In 2025, companies like Meta literally tied token consumption to performance reviews, complete with internal leaderboards. In one case, monthly burn reportedly exploded from 6 trillion to 73.7 trillion in a single month. But around May 2026, the mood flipped. Microsoft, Amazon, Meta, Uber, Tencent, Baidu, they all pivoted at roughly the same time. Per-person spending caps, smart routing to cut waste, scrapping pure usage rankings, refocusing on return on investment. And to be clear, this is not demand collapsing. It's the shift from mass experimentation to value validation. A Bain survey of 951 companies shows exactly why that shift matters. 54% of companies expected AI agents to deliver cost savings of 10 to 30%. Only 39% actually got there. 40% saw savings of less than 10%. The lesson? unlimited token burn does not automatically convert into business value. So if companies are tightening the purse strings, why does the growth story still hold? 4 reasons. Number 1, the agent paradigm shift. Work is moving from human to machine chat toward machines running loops on their own. Each task's token appetite jumps by orders of magnitude, and multiple agents running in parallel multiply it again. Gartner predicts that by the end of 2026, 40% of enterprise applications will have task-based AI agents built in. Number 2, Jevons paradox. When DeepSeek and others slashed the cost per token, demand didn't shrink. It exploded. Cheaper inference let more companies embed AI into their core workflows, and once it's embedded, it's extremely hard to rip out. Efficiency gains opened the demand floodgates instead of closing them. Number 3, penetration is still early. Today's token consumption is heavily concentrated in AI coding, and penetration there is still under 10%. There are roughly 20 million professional programmers worldwide, and close to 50 million if you count the broader group. The much bigger prize is everything else: office work, finance, legal, media. The global market for enterprise efficiency gains is estimated at nearly $2 trillion. Number 4, organizational change. Company-wide token budgets are becoming standard practice at large enterprises. Jensen Huang has suggested that on top of base salary, engineers should receive an annual token allowance worth roughly half their pay, because the productivity multiplier justifies it. When tokens go from an ad hoc expense to a formal budget line, consumption becomes institutionalized. Now let's zoom out and look at the forecasts, because this is where the numbers get wild. IDD projects that global active AI agents will grow from about 29 million in 2025 to roughly 2.2 billion by 2030. That's a compound annual growth rate of 139%. Annual token consumption? From essentially nothing today, a tiny fraction of 1 PETA token, to over 152,000 PETA tokens. A compound growth rate above 3,400%. Yes, you heard that correctly. IDC's Futurescape report adds that by 2027, global 2,000 enterprises will increase AI agent usage tenfold, while token and API call loads grow 1,000-fold. JP Morgan, looking at China alone, estimates AI inference token consumption rising from roughly 10 quadrillion in 2025 to about 3.9 quintillion by 2030. That's about 370-fold growth in 5 years, a compound annual rate around 330%. And the commercial data backs up the hype. Anthropic's annualized revenue run rate hit $47 billion in May 2026, nearly quadrupling in just 5 months. Salesforce's Agentforce product line is already generating hundreds of millions of dollars in annual recurring revenue. But here's the catch. The runway's huge, but it is not unlimited. Start upstream. In the first half of 2026, HBM and DRAM memory prices surged hard. Wedbush forecasts DRAM price increases of 130 to 150%. The era of dirt-cheap compute is taking a pause, and some model providers and cloud services have already started raising prices. On the enterprise side, budget discipline will squeeze out wasteful consumption. And inference efficiency keeps improving through better data, smart routing, and optimization tools, which could lower the token intensity per unit of output. Then there's physical supply. The giant spending discipline and capex pacing directly shape how fast infrastructure expands. Building a new gigawatt-scale data center takes about 2 years from construction to operation. Supply cannot just snap its fingers. So the metrics that matter have changed. It's no longer about raw token totals. Watch ARR, watch realized cost savings, watch output per token, and even token throughput per megawatt of data center capacity. So what does all this mean for American investors? The token demand curve is still in a steep climb, but the yardsticks are maturing. The leaders are shifting from growth at any cost to unit economics and cash flow quality. If that sounds familiar, it should. It's the same path the software as a service industry took from land grab to disciplined operations. Here's your watch list. Hyperscaler capital expenditure guidance and pacing. GPU rental rates and HBM and DRAM price trends. Third-party platform volumes like OpenRouter. Model makers' ARR and agent-related revenue. And how enterprises manage their internal token budgets and efficiency gains. The bottom line is this: the token itself is not the destination. It's the middle variable connecting compute investment to real business value. As long as agents keep penetrating, use cases keep spreading, and efficiency keeps improving, enterprise token consumption still has orders of magnitude of headroom from here. So what do you think? Are we in the early innings of the biggest infrastructure build-out in tech history? Or is this new era of budget discipline a warning sign? Drop your take in the comments. And as always, this video is for educational purposes only. It is not investment advice. Do your own research before putting money to work. Thanks for watching, and I'll see you in the next one.